Welcome everyone. Today we are going to understand debit versus credit from zero level in very simple language. First, let me clear one big confusion. Debit does not mean loss. Credit does not mean profit. Debit and credit only show movement of value. If value comes into the business, it is called debit. If value goes out of the business, it is called credit. Debit always show left side, credit always show right side. This is format, not a meaning. Think about your wallet. When salary comes in, money comes in, that is debit balance. When you spend or pay rent, it goes out from your pocket. So that is credit balance. In accounting, business is treated as a separate person. Always think from the business point of view. Here, drawings, assets, expenses are debit balance. Liabilities, equity and revenue are the credit balance. Here the table of the accounts, their balances, when what will affect accounts are increasing, accounts are decreasing, their debit balances. Assets are the things the business owns. When an asset increases, we debit it. When an asset decreases, we will credit it. Example, business buy a laptop of rupees 60,000. Laptop is an asset. Laptop is coming into business, so it is increasing. We will show that laptop in debit balance. Cash is going out. When we will purchase laptop, we will pay the cash, right? So laptop is an asset. It is increasing. We are showing her debit balance. Cash is going out. We will credit it. Same way, expenses are cost of running a business. Whenever an expenses occurs, it is always debit balance. Example, when electricity bill paid, electricity is debited. Here electricity expenses are increasing, so we are doing electricity bill debit balance. Cash is going out, that's why we are crediting the cash. In the same way, again, income means earnings of the business. Whenever income increases, it is credited. When goods are sold of rupees 10 lakhs, here cash is coming in, debit. Sales income is earned, it's credit. Sales are increasing. When revenue or income increasing, we will do the credit balance. When revenue is decreasing, we'll do debit balance. Again, liabilities. Liabilities are amount the business has to pay. When liability increases, credit balance. When liabilities are decreasing, debit balances. Capital, when owner brings money, cash is debited because it comes in. Capital is credited because business owes the owner. For every transaction, ask two questions. What comes in debit? What goes out credit? Do not think debit is loss or credit is profit. Understand the logic, not memorize. Always remember this. Value coming in is debit. Value going is out credit.